Litigation buyout or LBO insurance allows companies to ring-fence known, threatened, or pending litigation exposure and transfer both the risk and cost from the business to a third-party insurance carrier in exchange for a one-time premium to a bespoke insurance policy. These types of policies are usually leveraged by deal teams if they're in the course of an M&A transaction or some other type of financing transaction when they uncover potential litigation liability during their due diligence. The deal team can then leverage an LBO policy which negates requiring them to use expensive escrows or indemnities so that the deal can be completed and it can be completed on time. So each LBO policy is truly bespoke, and what that means is it's completely customized to meet the company's specific legal, business, and financial objectives. In exchange for an insurance premium, until the limit of liability is exhausted, the insurance carrier will do three things. One, they will direct and control the litigation, which does include making critical decisions regarding the settlement and the strategy, but they only do that in close consultation with the client. They will also, two, take financial responsibility for all of the defense costs, and lastly, cover the cost of any adverse judgment against the business. How might a company leverage litigation buyout insurance? Well, let's look at a case study. There was a private equity-owned HR company that was finalizing a sale, and it received a threatening letter about a potential wage and hour lawsuit. The company then consulted with their lawyers, and they calculated the estimated exposure to be around $11 million. So this threatened litigation really put the deal in jeopardy. The buyer was actually worried because its own due diligence had not detected the risk raised by the plaintiff's lawyer who set the letter. And then the buyer was also concerned about whether there would be additional issues that were lurking in the background somewhere. So in essence, the buyer was really beginning to get cold feet. So the seller turned to Certum Group to inquire about risk transfer through a litigation buyout insurance policy. We were able to do our due diligence and underwrite the risk and solve the problem. The LBO policy that we designed actually covered 70% more than the potential exposure, which ensured that the buyer would not have any money coming out of pocket. And then in the end, the policy gave all of the parties peace of mind and led to a pathway not just to close the deal, but to close the deal on time. Well, by leveraging an LBO insurance policy, companies can avoid a lot of the problems that are inherent with some of the traditional solutions, which would include things like very large escrows, overpaying for an ill-timed settlement, having a negative balance sheet impact, or simply having a deal that completely falls apart. So LBO policies provide risk transfer, as I mentioned, for known, threatened, or pending litigation in exchange for that fixed cost. They cover all of the financial risk of the litigation, all of the defense costs, and the cost of the adverse judgment. At the end of the day, that facilitates M&A and other types of financing transactions because it has ring-fenced all of the litigation. And perhaps most importantly, it helps the business achieve financial certainty so that the company can get back to running its core business.